This is Trench Limited. I'm sorry the screen is so crowded. The question is here and the answer is the rest of it. So it might be an idea if you've got the question open in your manual beside you. Let's make a start then. We follow a reasonably clear format, and we start with cash flow from operations, looking at the profit, adjusting for the non-cash elements, and moving the finance cost out of the operating activities. We then look at the working capital movements, and we then look at the finance elements, the interest paid and tax paid. That gives us net cash flow from operating activities, being the operating activities and the direct finance activities. Then cash flow from investing, and that is basically movements on our non-current assets. And then cash flows from the financing activities on the equity and liability side of the statement of financial position. Those are the headings, and we go through them in a reasonably set manner that is standard no matter what the company. We start with our profit before tax, and the kind of hidden assumption there is that that is all cash flow, which of course it isn't. And we take out our interest, our finance cost given there, that's our profit from operations. So we take out that in order to calculate it later on in the statement. So our profit from operations is 1010, deduct the 160, that gives us 850 as our profit before tax. We then have this non-cash deduction from the profit that we need to add back in, and the previous video explained why that's the case. So we add that back in. Then we have gain on disposal of assets, and we're warned about this in note 3 here, where it talks about the company selling a tangible asset for 70,000. The asset had a cost of 600,000 and the accumulated depreciation was 540,000. So the net book value was 60,000 and the selling price was 70,000. So that's a profit of 10,000. If we work it out in terms of the actual debits and credits of the account, we've got here a debit of 60,000 for the fixed asset. It sits in the debits. The depreciation provision is 540,000, so that gives us our net book value of 60,000 debit. We credit a sale of 70,000 and debit, we assume that we debit cash, and that leaves us with a total on this side of 540 plus a 70, which is 610,000. And to make up these 610,000, it implies a 10,000 profit on sale. So that's a profit on sale. Profit is not a cash flow. It's you don't get paid your profits, you get paid revenue. So we need to note that this revenue as a cash flow, and we need to take out this profit on sale as being an artificial, not artificial, but a non-cash addition to our profit account. So we deduct that, taking out the profit there, and that gives us a net addition to our profits of 740. We now look at our finance cost, and we've got the finance cost there of 160. That we have just added back into our profit figure. We're going to adjust for the actual payment later on. And then we have our increase in provision and that is on the lawsuit, and that is here in this question. Where's it got to? There we are. Increase it in provision from 60 in 2010 to 160. So that is an increase in our finance provision there, and that's going to have a positive effect on our cash flow. We've deducted it from our profit, our income statement, if you like, or profit and loss account, as it's often called. We've deducted, so we must add it back in. And the finance one is just something that we've moved from up there to down there, so we didn't worry too much about that. But the increase in provision, we've deducted it from our profit and loss account, so we need to reverse that. So in that sense, it's similar to the depreciation, which is also a provision. We now come to changes in working capital, and this we have explained in the previous video on cash flow statements. So we've got an increase in inventories, which is a negative, a use of cash, if you like. We've got an increase in receivables, and that is reversing the assumption that all our sales were for cash. Some of them were not for cash, and it just resulted in an increase in our receivables. And a decrease in payables, we must have paid them. So negatives all through. So refer to the previous video for an explanation of that. The total drain on our cash flow is 420. So it's partly a reversal of our assumption that the 850 is all cash flow. Now let's have a look at the interest actually paid. We have accrued interest of 40. Now why do we start looking at this? Well, it's on the balance sheet, so we must start to look at it in detail. We can't just leave it as something just adjusted for up here. We've got to look at the actual payment, because we have accrued interest going from 40 in the previous year down to 20. Our opening accrual is therefore 40. The charges we incurred during the year come to 160. The closing amount is 20, and therefore we must have paid 180. So there's quite a bit of this working out the missing figure and assuming that that missing figure must be payment. Now you can sort of present it as a kind of statement, if you like, but in your head you should understand the debits and credits of it and how it's worked out. So you could have a statement saying opening accrued interest 40 plus the finance cost charged during the year minus the closing accrual equals our 180. You could have a statement like that, or you can just reproduce a little T account in effect here. Tax is also on the statement of financial position here. Here it is, tax under current liabilities. So we must do much of the same thing as we did with interest. Here's the account, the opening balance on our tax account, we were owing 330. During the year we incurred charges of 300, but there's a difference between charge and what we actually pay. The closing amount that we were owing is 260. Hopefully I'm reading that correctly. Hang on. Yes, that's right. The closing balance is 260, so we owe them at the end of the period 260. Therefore, we must have paid them 370 as the balancing figure in our account. Again, you could have presented this as a statement that the opening amount owing plus the charge during the year minus what we owed them at the end equals what we must have paid them, which is 370. But again, you should be able to translate it back into account form. So that accounts for our tax paid of 370, which is this figure here. Now we have our cash flows from investing activities. The first one being essentially working on our movement in fixed assets, or non-current assets as they're called. These are these figures up here. In 2010 the balance was 5,000 and in 2011 it was 5,330. We take much the same process as we did in the previous accounts. Our opening balance is 5,000 as a debit. Now we're talking about net book value here, and it is noted up here as net book value. So in the account we must have credited the depreciation for the year, which is 750,000, and we've got our disposal, and that's the net book value of the disposal. We take it out of our basic accounts, right? That's the 600,000 minus the 540. That's a debit of 60,000, which we credit to our account and debit to the disposal of assets account. So the net figure is a debit of 60. So we credit that to get it out of our out of our fixed asset account and debit our disposal account. And now, because we've gone through this question very carefully, we have our revaluation reserve. So that must have been an entry into our non-current assets. They've been revalued. It's non-current assets that you would revalue. It doesn't tell you this. It doesn't give information in the notes. It's a little bit mean, but we've got to do something with this. So looking at the effect of that is going to be a credit to the revaluation reserve and a debit to our net current non-current assets account. So it's a debit there and it's a debit here and a credit there. Given that its effect is to increase our value of our assets by 200, but it's a non-cash increase. So we're working through this account, putting all the entries that we know about, and the balance is going to be whatever we paid for acquisition. That just about puts it all together. It's not simple. We've got the opening balance here. We've got the depreciation charge must have gone in. We've got the net book value that was taken out of our non-current asset account. We've got our revaluation reserve adding to the debit value of the account, increasing our non-current asset valuation, which is what we'd expect. And we've got the closing value of 5330. Our missing figure we have to take as acquisitions. Whether they paid for it in cash or not is we don't know, but we are going to assume that it's cash and then adjust for the cash non-cash elements in our working capital, which we have already done. On that basis, therefore, we put minus 940 as cash flows from our an outflow from our investing activity. And then we put the 70 from our disposal of assets, which is the sales figure here that went into the profit. In our profit and loss account, we just reported the profit. We've unwound the profit, and we now also need to treat the sale as being a positive cash flow. Whether it resulted in sales or an increase in receivables is something that is adjusted for overall up here. So a positive figure on the 70, and net cash from investing activities is 870, the total of those two. Now we have the cash flows from financing activities. We have share issue, which is in 2010 it was that plus that, the 1,200, and then in 2011 it was 1,200 plus 350, so 1,550. So 1,550 minus the 1,200 is 350. So there's been share issue of 350, and that probably was straight cash. Now we have on the other long-term finance side of things, we've got the repayment of loans, and here we have our non-current liabilities, 8% loan notes. It's best to tick these things off as you go along. This would be unticked, so you know it went from 1,600 down to 1,200, so that's a straight 400 negative. Right, we've repaid a loan, so that's treated as a cash outflow. And then we have dividends paid, and that is occurring in our statement of changes in equity, the minus 300 there. So we need to put that in as a negative effect on our cash flow, sometimes called funds flow. Total of that comes to minus 350, and if we add up the 880 minus the 870, so that's a positive 10, minus the 350 gives us minus 340 as our net cash flow for the year. We started the year with a cash and cash equivalents of 250, and if we go to the statement of financial position here, we've got cash at bank and current investment, so that's near cash. So the 100 plus the 150, and we've got no bank overdraft. So that value comes to 250. And then at the end of the year, we have 340 less. So 250 minus 340 is minus 90. And that minus 90 is made up of our 20 current investments, our 10 cash at bank, all seems to have gone down a lot, and also our bank overdraft of 120. So it's 20 plus 10 minus 120 is our minus 90. And that explains our cash flow statement. Note the marking here, it's marked item by item. So if you understand each item, then you're going to pick up a lot of marks. So don't worry about the whole thing. Concentrate on getting the individual items correct. I'm pretty sure that in professional exams, if they have to do a cash flow statement, very few will actually be a fully successful statement. So don't think that just because you cannot explain the closing balance, you've got the question wrong. It's not a question of that. It's just getting as many bits of it right as you can. And that is how professional papers are marked, and that is how this question is marked. Okay, so that completes our Trench PLC question.